You pay an insurance company money every single month, for years, sometimes decades, for a product you are actively hoping to never use. Think about how strange that actually is. You don't buy a gym membership hoping to never work out. You don't buy a streaming subscription hoping to never watch anything. But with insurance, the entire relationship is built around a shared, unspoken agreement. You pay, and the company quietly hopes, and in a very real financial sense, needs, that you never file a claim at all. So here's the real question this video is actually about. If the whole point of insurance is supposedly to protect you when something goes wrong, why is the company's ideal customer someone for whom nothing ever does? This isn't a cynical take or a conspiracy theory. It's the literal foundation of how the entire insurance industry is structured, documented in the plainest possible financial language. Every insurance company publishes something called a loss ratio, the percentage of premium income that actually gets paid back out in claims. It's a required, publicly reported number, tracked by regulators, watched closely by investors. And across the industry, a lower loss ratio is treated as a sign of a healthier, better-run company. Read that plainly. The official, industry standard measure of insurance company performance is explicitly better when the company pays out less of what it collected. That's not an accident of language. That's the business being honest about its own math, right there in a regulatory filing. Now, the easy explanation is insurance companies are just greedy and want to deny claims. And sure, claim denials happen, and they're a real, documented frustration for a lot of policyholders. But that explanation alone doesn't fully hold up, because insurance companies don't actually want to deny valid claims aggressively. Doing so consistently and unfairly gets them sued, regulated, and eventually driven out of business by reputational damage and legal costs far larger than the claims themselves. If pure claim denial were the strategy, the entire industry would collapse under lawsuits within a few years. It hasn't. Multi-trillion-dollar insurance markets have operated this way for well over a century, which means something more structural than simple greed is actually driving the math here. Here's the piece almost nobody explains clearly. Insurance was never really designed to be a savings account you draw from when something bad happens to you personally. It's a risk pool. Thousands, sometimes millions, of people pay into a shared fund, and a relatively small number of them, in any given year, experience the event the insurance actually covers. The math only works. The whole system only works because most people who pay in during any given year do not experience a covered loss during that same year. Which means an insurance company isn't secretly hoping you personally never have a covered loss out of spite. It's mathematically dependent on the fact that, across its entire pool of customers, the overwhelming majority won't, in any given year. Because that predictable majority is the entire mechanism that makes it financially possible to pay the minority who genuinely do. And this is where it gets genuinely more interesting. Because insurance companies don't just passively wait to see who files a claim and who doesn't. There's an entire discipline, actuarial science, built specifically around predicting, with startling precision, exactly how many people in a given pool will experience a covered loss in a given year and exactly how much that will cost. And once you understand how precise that prediction actually is, the entire pricing model of insurance starts to look completely different. Actuaries build statistical models using enormous historical data sets. How often people in a certain age group get into car accidents. How often homes in a certain zip code experience fire or flood damage. How often people with certain health profiles develop specific conditions. And use that data to calculate, with genuine mathematical rigor, the expected cost of insuring any given individual or group. Your monthly premium isn't an arbitrary number. It's a calculated estimate of your individual expected payout, spread out over time, plus a margin for the company's operating costs and profit. Which raises the real question this video is actually about. If the pricing is that precise, how much room is actually left for profit once you account for how accurately insurers can predict exactly what they'll have to pay out? Here's the mechanism, named plainly. It's the same core principle behind nearly every insurance product on Earth, the law of large numbers. Individually, nobody can predict whether a single specific person will get into a car accident this year. But across a pool of 1 million drivers, actuaries can predict, with remarkable accuracy, roughly how many accidents will happen, how severe they'll be on average, and what they'll cost, almost down to a tight statistical range. That predictability at scale is the actual product insurance companies are selling, not protection against chaos, but a mathematically managed system that converts millions of individually unpredictable outcomes into one highly predictable, priceable number. So the reframe here is this: you're not really buying protection from your insurer. You're buying access into a very large, very carefully modeled pool, priced specifically so that pool, taken as a whole, generates predictable profit for the company running it, while still, on average, paying out real money to the real minority of people who do experience a genuine loss. Both things are true at once. The system genuinely helps the people who need it, and it's also mathematically engineered to be profitable regardless. And once you see it this way, you start noticing how much of the entire insurance customer experience is quietly built around encouraging exactly the behavior that keeps that math working in the company's favor. Loyalty discounts for long-term customers who never file claims. Safe driver programs that track your habits and reward the ones least likely to result in a payout. Health insurance wellness incentives nudging you toward exactly the behaviors actuaries already know reduce claim costs. None of these are just nice perks. They're precisely targeted at the specific customer profile the pricing model was built around in the first place. So here's the number. Industry-wide loss ratios across major insurance categories, auto, home, health, life, commonly sit somewhere in a broad range of roughly 60 to 80%, depending on the line of business and the specific year. That means, on average, for every dollar collected in premiums, somewhere between 60 and 80 cents eventually goes back out in claims. That remaining 20 to 40 cents has to cover the company's operating costs, marketing, salaries, reinsurance. Insurance that insurance companies themselves buy to protect against catastrophic losses. And, after all of that, whatever's left becomes profit. It's a thinner margin than most people assume, which is exactly why the precision of the underlying prediction matters so enormously to the entire business. Now, if a 20 to 40 cent margin sounds surprisingly modest for an entire industry this large, wait until you see what happens to that math the one time a prediction goes seriously, catastrophically wrong. Because the entire system has a second, much larger and much stranger mechanism built specifically to survive exactly that scenario. And it involves an entire hidden layer of the insurance industry that almost no ordinary customer ever hears about. Here's the layer most people miss completely. Insurance companies buy their own insurance. It's called reinsurance, and it exists specifically to protect insurers themselves from the rare, catastrophic years when the actuarial math gets overwhelmed. A massive hurricane, a widespread pandemic, an economic shock that triggers an unusually large wave of claims all at once. Large reinsurance companies, some of them centuries old, essentially agree to absorb a portion of an insurer's losses above a certain threshold in exchange for a share of the premium. It's insurance, wrapped around insurance, specifically engineered to make sure that even a genuinely catastrophic, statistically rare event doesn't sink the entire predictable system underneath it. Which means the you never filing a claim dynamic isn't even the whole picture of how this industry protects its own math. It's layered multiple times over. Individual policyholders paying into a pool, that pool priced using precise actuarial prediction, and that entire pool then partially reinsured against the rare years when even precise prediction isn't enough. Every layer exists to do the exact same thing: convert unpredictable individual chaos into a stable, priceable, profitable system. Here's why this matters beyond just understanding an insurance company's balance sheet. Once you see the mechanism clearly, you start to understand why your own individual claims history matters so much more than it might seem like it should. A single claim, even a relatively small one, can follow you for years through rate increases, not necessarily because the insurer is punishing you personally, but because your claim just moved you, statistically, into a slightly different risk category than the ideal, predictable customer the pricing model was originally built around. This is also exactly why some people quietly avoid filing genuinely small claims even when they're entitled to. And it's a rational response to how the system actually works, not paranoia. A single minor claim might cost you less to just pay out of pocket than the accumulated rate increase you'd face over the following several years for having filed it at all. Insurance companies know this dynamic exists, and the pricing structure around small claims is, in part, quietly designed around the expectation that a meaningful percentage of policyholders will simply choose to absorb minor losses themselves rather than trigger it. And this is where the story gets genuinely counterintuitive, because it means the entire system isn't really built around insurers, hoping individual people don't have bad luck. It's built around a much colder, much more precise mathematical target, keeping the pool's overall claim frequency and severity within the range the actuarial model predicted. An individual customer who never files a claim isn't specifically valuable to the company as a person. They're valuable as a data point that keeps the entire pool's math landing exactly where it was priced to land. So here's the full mechanism, all the way through. Insurance is a risk pool, not a personal safety deposit box. Actuaries price that pool using enormous historical datasets and the law of large numbers, converting millions of unpredictable individual outcomes into one highly predictable, priceable system. The published loss ratio openly measures how much of that premium comes back out in claims, and the remaining margin, typically 20 to 40 cents on the dollar, funds operations and profit. When the math gets overwhelmed by a genuinely catastrophic year, reinsurance absorbs the shock, protecting the entire system underneath it. None of this requires an insurer to be malicious toward any individual customer. It only requires the pool, as a whole, to behave the way the actuarial model predicted it would. Which leaves an interesting question worth sitting with. As insurers gain access to increasingly granular real-time data, wearable health devices, telematics tracking your exact driving behavior, smart home sensors monitoring for leaks or fire risk, does the entire risk pool model start to break down into something closer to individual pricing for every single person, based almost entirely on their own personal behavior rather than a shared statistical pool at all? And if it does insurance stop being a shared safety net for the unpredictable and start becoming something closer to a real-time, personalized bill for exactly how risky you, specifically, are choosing to be? This is exactly the kind of thing this channel exists to unpack. Not the simple, cynical version of insurance companies just want your money, but the actual, precisely engineered mathematical system quietly running underneath an industry nearly everyone pays into and almost nobody fully understands. If you want to keep seeing the real mechanics behind the prices, fees, and systems you deal with every day, subscribe. Because next up is something you've probably felt without ever being able to name. Why the middle option on almost any menu of choices, from a coffee size to a phone plan, is very rarely an accident, and is very often the exact option a company wants you to pick before you've even started comparing. Next time you pay an insurance premium and nothing happens that month, you haven't wasted your money. You've just been the exact, predictable data point the entire system was mathematically built to need.